Friends, thank you for being here today. It is a pleasure to sit down with you, to cut through the noise of the nightly news, and to really look at the mechanics of the world we are living in. We have lived through decades of change, from the booming post-war era to the stagflation of the 70s, the tech bubbles, and the financial crises. But what we are seeing now, this rewiring of the way the world trades and talks to one another, is something unique in our lifetimes. What if I told you that the economic rulebook we have relied on for the last 30 years is being rewritten in real time, right in front of our eyes? And furthermore, what does it mean for your retirement, your grocery bill, and your peace of mind? When the world's largest economies stop cooperating and start competing in a high-stakes game of winner takes all? As we stand on the precipice of 2026, counting the costs of the past year and looking toward the horizon, two words seem to define our collective reality: disruption and uncertainty. The year 2025 has already earned its moniker in the history books, the year of tariffs. It was the year the global trading system, which had been moving toward openness for decades, suddenly threw up walls. From Washington to Beijing, from the mineral-rich soils of Africa to the historic capitals of Europe, economic power is shifting. Supply chains, the invisible highways that bring everything from your morning coffee to the medication in your cabinet, are being rewired. But the big question, the one that keeps economists up at night and weighs on the minds of families sitting around the kitchen table, is simple. Will 2026 bring any relief? Or are we destined for a more fragmented, expensive, and difficult world? To answer this, we must look at how we got here, how the common sense of tariffs is colliding with the hard reality of pricing, and who is really winning in this new global order. To understand where we are truly going, we first have to look back at the strategy that started it all. To understand where we are going, we have to look at the shock to the system that occurred in April 2025. This was the moment the United States imposed duties on goods from nearly every country in the world. This wasn't a surgical strike, it was a blanket approach that upended global trade overnight. For the administration, specifically under the direction of President Donald Trump, the rationale was straightforward. In his view, the complexities of international trade economics could be boiled down to a simple formula. When asked how these rates were calculated, the president described it not as a product of complex econometric modeling, but as a formula based on common sense. The logic, as presented to the American people, was rooted in raw numbers and historical grievances. The argument was that the United States had been treated unfairly for decades, running massive deficits while other nations grew rich on American consumption. And the tariffs were presented as a corrective measure, a way to punish countries that had not been good to the U.S. Specific nations, such as Brazil, found themselves in the crosshairs, not necessarily for a single specific act, but for a general sentiment of being difficult partners. The stated goal of this economic nationalism was twofold: to cut the trade deficit, the difference between what we buy from the world and what we sell to it, and to bring manufacturing jobs back to American soil. It is a nostalgic and powerful promise, the idea that we can return to an era where the things we buy are made in the towns we live in. However, the reality of implementing this common sense has been anything but simple. The global economy is not a series of isolated islands, it is a spiderweb. When you pull on one thread, like slapping a tariff on imported steel or electronics, the vibration is felt everywhere. Some economies, particularly our traditional allies in the European Union and the United Kingdom, manage to scramble and negotiate new deals to soften the blow. Others are still in the thick of negotiations, trying to find a way through the wall. But the aftershocks are still rolling through the system. Now, you might expect American business to be on board with this, but we are seeing a surprising rebellion in the corporate world. Perhaps the most telling sign that this new economic era is rocky is the reaction from American business. Historically, the Republican Party and big business have walked largely in lockstep, but 2025 shattered that alliance. We are seeing a phenomenon that would have been unthinkable a few years ago: major American corporations suing a business-friendly administration. Take Costco, for example. We all know Costco. It's where many of us go to stretch our pension checks, buying in bulk to save a few dollars. Costco is not known for political activism. They are known for hot dogs and paper towels. Yet, Costco has become the largest retailer to sue the Trump administration over these tariffs. Why? Because for a retailer that relies on global supply chains to keep prices low for you and me, these tariffs are not an abstract policy. They're a direct hit to the bottom line and, by extension, to the customer's wallet. Costco, joined by other household names like Bumblebee Foods and Revlon, is arguing that the president exceeded his authority. They are pointing to the 1977 International Emergency Economic Powers Act, arguing that Congress never intended for a president to have this much unilateral control over the flow of commerce. But beyond the legal arguments, there's a frustration with the method. In the lawsuits and corporate statements, you hear complaints about the pell-mell manner in which these duties are applied. Business relies on predictability. You need to know what a toaster will cost next year to order it today. But in 2025, tariffs were threatened, modified, suspended, and reimposed with dizzying speed. For corporate America, the message is clear. We cannot plan for the future when the rules change every time a new press release is issued. And if Costco is worried about the cost of goods, every American shopper should be paying attention. This brings us to perhaps the most important part of the equation: how all of this is impacting you and your neighbors. This brings us to the most important part of the equation: you, the consumer, the voter, the person paying the bills. If there is one thing that shifts political tides faster than anything else, it is the price of milk, bread, and gas. And on the issue of tariffs, the American public has undergone a dramatic change of heart. Let's look at the numbers, because they tell a fascinating story of how reality catches up with rhetoric. Back in November 2024, immediately following the election, there was a sense of optimism, or perhaps a willingness to try something new. At that time, 52% of Americans favored new tariffs on imported goods. It sounded like a good idea: protect our workers, tax foreign competitors. But fast forward just 1 year to October 2025. The theoretical idea of tariffs had collided with the reality of price tags. Support collapsed. By late 2025, a clear majority, 62% of Americans, opposed new tariffs. Why the reversal? It isn't a mystery, it's inflation. When asked, 72% of Americans stated they believe tariffs are directly raising prices in the short term. We are seeing this at the checkout counter. The cost of doing business has gone up, and companies are passing that cost on to us. The administration, sensing this frustration, floated the idea of tariff rebate checks, essentially a stimulus check funded by the money collected from these taxes on foreign goods. It's an appealing idea: tax China and give the money to the American senior citizen. However, we must be realistic about these promises. The prediction markets, where investors put real money down on what they think will happen, are not optimistic. Currently, the data suggests there's only a 25% chance that just 1 in 4, that Americans will see any such check by August 2026. We are left in a difficult position. The promise of bringing manufacturing jobs back is also hitting a hard wall of reality. Even if factories return, the economics of 2026 are not the economics of 1960. Consider the wage gap. A manufacturing worker in the US earns an average of roughly $60,000 a year. In China, that's so, even if the factories return, the jobs might not. We might be paying higher prices for goods to protect jobs that are largely being done by machines. This is the housing crunch and labor shortage paradox. We have help-wanted signs, yet households are squeezed by mounting debt and rising costs. Let's look across the ocean to the primary target of these policies, where a high-stakes game of economic hide-and-seek is playing out. Now, let's look across the ocean to the primary target of these policies: China. The entire premise of the year of tariffs was to confront China, to balance the scales, and to reduce their dominance. So, did it work? The answer is, quite frankly, astonishing. Despite the aggressive tariffs, despite the rhetoric, and despite the barriers, China recorded a trade surplus of over $1 trillion in 2025. Some economists believe the real number, when you account for hidden data, is closer to $1.2 trillion. This is the largest trade surplus in recorded human history. How is this possible? How can the US slap massive taxes on Chinese goods, and yet China sells more than ever? The answer lies in a global game of shell games, or what economists call transshipment. When the US makes it expensive to buy directly from China, Chinese companies don't just pack up and go home. They adapt. They are nimble. Supply chains have been rewired. Exports from China to the United States have indeed collapsed. The policy worked in that specific narrow sense. But look at where Chinese exports surged: Vietnam, Mexico, Taiwan, and other Southeast Asian nations. Here is what is happening. A component is made in China. It is shipped to Vietnam or Mexico. It gets a little bit of finishing work done, maybe a new label, and then it is shipped to the United States. Because it comes from Mexico or Vietnam, it avoids the China tariff. It is trade diversion, not trade destruction. The goods are still arriving. They are just taking a longer, more expensive route. Furthermore, we must respect the sheer scale of the industrial machine China has built. China now accounts for 35% of global manufacturing output. To put that in perspective, that is roughly equal to the next 10 industrialized countries combined. They are not just using cheap labor anymore, they are using technology. China utilizes 55% of the world's industrial robots. In terms of pure efficiency, studies show that in certain industries, a Chinese worker, aided by this technology and infrastructure, produces 2 to 3 times more output than an American counterpart, despite being paid 80% less. This is a structural gap that tariffs alone cannot fix. The U.S. demand for goods remains high, and China is still the only factory big enough to supply them, whether they ship them directly or route them through a neighbor. Of course, this economic wrestling match isn't just affecting the US and China, it is reshaping the entire map from Africa to Europe. This economic wrestling match between the US and China is not just affecting our two nations, it is reshaping the entire map. The scramble for Africa. We are witnessing a new gold rush in Africa, but it isn't for gold, it is for the critical minerals, lithium, cobalt, copper, that power of the 21st century. These are the ingredients for electric vehicle batteries, smartphones, and the massive data centers running artificial intelligence. The US, Europe, and China are all courting African nations, trying to secure access. But here's where the dynamic has shifted. African nations, led by heavyweights like South Africa, which recently presided over the G20, are seizing the moment. They are refusing to be just extraction pits for the West or the East. They are demanding that the processing and manufacturing happen on their continent. They are playing the powers against each other, taking investment from the UAE, Japan, Brazil, and China, and refusing to pick a single side. It is a moment of empowerment for the global South, demanding a seat at the table and a fairer share of the wealth. Europe's dilemma: guns versus butter. Meanwhile, our friends in Europe are facing a darker reality. The America First policy has put immense pressure on the European Union to become self-reliant, particularly on defense. For decades, Europe relied on the US security umbrella. Now, with Washington demanding they pay their fair share and with security fears rising on their eastern border, the EU is boosting military spending to record highs. But money is finite. Every euro spent on a tank is a euro not spent on healthcare, pensions, or education. Countries like France are already straining under high debt. Critics are accusing these governments of choosing weapons over welfare. For the European retiree, the fear is palpable. Will their social safety nets survive this pivot to a war-footing economy? The one silver lining for Europe is that inflation there is somewhat under control, largely because the price of oil and agricultural goods has been falling, deflation, which eases the pain slightly. But the social contract in Europe is fraying under the pressure of this new geopolitical reality. Looming over all of this, tariffs, trade wars, and debt, is the shadow of a new technological revolution. Looming over all of this, tariffs, trade wars, and debt, is the shadow of the artificial intelligence, AI revolution. In 2026, this is no longer science fiction. It is the economic engine driving the stock market. Tech giants are placing billion-dollar bets, racing to win the AI arms race. For the economy, AI is a double-edged sword. Supporters, mostly the corporations investing the money, say it will make businesses more productive than ever, potentially ushering in a golden age of efficiency. But economists, including Nobel laureates, are sounding a note of caution. They compare this to the first industrial revolution. Yes, eventually the steam engine made the world richer. But for the weavers and craftsmen of the 1800s, it brought decades of misery and job displacement before the benefits were shared. We risk entering a similar period. AI might boost the GDP, but it could displace millions of administrative and creative jobs. For the worker nearing retirement, this might not be a threat. But for their children and grandchildren, the question of what will I do for a living is becoming harder to answer. Now, there's another massive piece of this puzzle that we often overlook, but it underpins everything we have discussed so far: the debt and the dollar. Before we look at our own bank accounts, we have to look at the world's bank account. Because there is a quiet crisis brewing that affects the value of every dollar in your pocket. We are living through a unique moment in history where the world's two largest economies are playing a very dangerous game of chicken with their national ledgers. On one side, we have the United States running recurrent, massive budget deficits. To fund everything from the military buildup to the potential tariff rebate checks we discussed earlier, the government is borrowing more money than ever before. We are essentially putting the current economy on a credit card that our children and grandchildren will have to pay off. But here's the catch. For decades, we could do this because the world was happy to lend us money. They bought U.S. Treasury bonds because the dollar was the undisputed king, the safest harbor in a storm. But look at the other side of the ledger. China is running a historic trade surplus, accumulating trillions of dollars. In the past, they would have taken that profit and recycled it back into buying American debt. It was a symbiotic relationship. We bought their goods, they bought our bonds. But that cycle is breaking. As we weaponize the dollar with sanctions and tariffs, countries like China and indeed the broader global South are looking for alternatives. They are buying gold. They are settling trades in their own currencies. They are slowly, quietly, trying to de-dollarize the global economy. Why does this matter to you? It matters because the strength of the dollar is what keeps our imports relatively cheap and our interest rates manageable. If the world's appetite for U.S. debt fades while our borrowing accelerates, the laws of economics dictate that interest rates must rise to attract lenders. That means higher mortgage rates, higher credit card rates, and a higher cost to service the national debt itself. which eventually eats into the budget for Social Security and Medicare. We are seeing a divergence. While the U.S. consumer is being squeezed by inflation, the U.S. government is straining under the weight of its own obligations. It is a precarious balancing act. The risk in 2026 isn't just a recession, it is a repricing of what it means to be the world's reserve currency. If the dollar weakens significantly because of this debt burden, the inflation we have seen in 2024 and 2025 could look mild by comparison. It is not a doomsday scenario, but it is a flashing yellow light on the dashboard that we simply cannot ignore as we plan for the long term. Now, friends, I want to pause the geopolitical tour for a moment and look at the ledger that matters most, the one in your checkbook. We often talk about the economy as if it were a weather system happening to us, something distant and abstract. But these shifts, the tariffs, the mounting national debt, the AI race, have a direct line to your retirement security and your daily life. We need to have a frank conversation about the personal economy of 2026 because the rules of retirement planning are shifting beneath our feet. First, we must address the silent tax of sticky inflation. While economists might celebrate when the rate of inflation slows down, you and I know that prices rarely go backward. Tariffs act as a consumption tax. When a 25% duty is placed on imported goods, that cost is almost always passed down to the final buyer. For those of us on fixed incomes, whether it's Social Security, a pension, or an annuity, this is a significant challenge. The cost of living adjustments, COLA, often lag behind the real-world price increases of the things seniors spend the most on: healthcare, insurance, and services. In 2026, your dollar simply does not stretch as far as it did in 2024, and unlike a wage earner, you cannot simply ask for a raise to match the new reality. I would love to hear your perspective on this. Are you seeing these price changes at your local store, or is your budget holding up? Please share your experiences in the comments below. Then there's the issue of the housing lock-in. For decades, the standard American retirement plan involved downsizing, selling the big family home, taking the equity, and moving to a smaller, more manageable place. But the economic policies of the last 2 years have broken this ladder. With government borrowing hitting record highs to fund defense and industrial subsidies, interest rates remain structurally higher. This has created a golden handcuff situation. You might be sitting on a home that is appreciated in value, which looks great on paper. But if you were to sell that home and buy a smaller condo, you might find yourself trading a 3% mortgage for a 7% or 8% one. The math doesn't work. This lack of mobility is freezing the housing market, keeping inventory low, and paradoxically, keeping home prices high even as demand softens. It leaves many seniors house rich but cash poor, unable to access the wealth they spent a lifetime building without taking on expensive debt. Finally, we cannot ignore the elephant in the room, the national debt. We are living in an era where major economies, the US, Europe, and China, are all borrowing massive amounts of money simultaneously. They are borrowing to rearm, to subsidize AI, and to build new supply chains. When everyone competes for the same pool of global capital, the cost of borrowing goes up. For the saver, this might seemingly offer a silver lining in the form of higher interest rates on savings accounts or CDs. However, this is often a mirage if inflation is eating up those gains. More concerning is what this means for the stability of the bond market, the traditional safe harbor for retirement portfolios. As we saw in 2025, when government debt balloons, bond markets can become volatile. The old 60-40 portfolio strategy, 60% stocks, 40% bonds, is being stress tested like never before. In 2026, prudence means looking for resilience, investments that can weather inflation, rather than just chasing growth. So, bringing it all back home, what does this actually mean for us as we look at the calendar for 2026? The consensus among serious economists is not to panic, but to prepare. A full-blown recession, a total collapse of the economy, is not the baseline prediction. The global economy has proven to be incredibly resilient. We have weathered the post-COVID storms, the inflation spikes, and now the tariff shocks. However, we are heading for a slowdown. The two main engines of the world economy, the United States and China, are sputtering. In the US, the labor market is softening. It's harder to find a job than it was a year ago. In China, the property crisis has crushed consumer confidence. Retail sales are down. People are saving, not spending. When these two giants slow down, the whole world slows down. For 2026, the forecast is disruption and uncertainty. We are likely to see continued high prices. The tariffs are baked into the system now. Those costs are not going away. Interest rate volatility. As governments borrow more for defense, for tech subsidies, debt mounts, which keeps financial markets on edge. A fragmented world. The era of easy, cheap global trade is over. We are moving into blocks. The US bloc, the China bloc, the non-aligned bloc. If you found this analysis helpful and want to stay informed on these economic changes, please consider liking this video and subscribing to the channel. It really helps us reach more people like you. In closing, I want to leave you with this thought. Friends, the world of 2026 is going to require patience and prudence. The easy money days are likely behind us. The promise that tariffs would solve our problems has proven to be more complicated than the common sense formula suggested. We are left with a world that is more expensive and more dangerous, but also one that is adapting. As we watch our savings and plan for our futures, we must remember that resilience is not just an economic term, it is a personal one. We have navigated shifts before. We will navigate this one too, but we must do so with our eyes open, recognizing that the cost of this global reordering is being paid, ultimately, by households like yours and mine. Thank you for your time today. Let's keep watching, keeping questioning, and looking out for one another.